There's a new deduction on your 2026 tax return worth up to about $12,000 if you're married and you're both 65 or older. But if your household income lands between $150,000 and say $250,000, part of that money disappears before you ever actually see it. No letter from the IRS telling you what happened. No one kind of guiding you on this unless you have tax professionals or financial advisors that you work closely with. I'm Jonathan Bednar, certified financial planner at Paradigm Wealth Partners, and I've worked with hundreds of retirees. And these are the exact strategies that we are working with our clients and helping them navigate. So what I want to do is talk about this deduction, what it actually is, who loses part of it, and why the same income that shrinks this deduction can also raise your Medicare bill 2 years from now. So let's first talk about the senior bonus. So what's new for 2026, if you're 65 or older, there's a brand new deduction stacked on top of everything that you are already getting. And here's how it stacks for a married couple, both 65 or older. So you get the standard deduction, that's $32,200. There's an additional deduction for being over age 65, so that's an additional $3,300 or $1,650 per person. And then there's a senior bonus deduction of $12,000, so a total deduction of $47,500. Now, if you're single and over 65, your total is $24,150. So these are real numbers, not a rule of thumb, not an estimate. And for a lot of retirees, it sounds like the government just handed them free money, which everyone would love. Reality is, it's not free money. There's a phase-out trap. So let's take Mark and Diane, both 66. They got a pension, Social Security. They take some distributions out of their accounts. And so when you stack all that together, their combined income is about $200,000. Mark and Diane assume they're getting the full $12,000 bonus deduction. And most retirees in their income range assume the same thing. And they're wrong. The deduction starts phasing out at $150,000 for married couples. So for Mark and Diane, who are $50,000 over that line or that limit, for every dollar over, they lose 6 cents of the deduction. So on that math, $50,000, Mike and Diane would lose about $3,000 of their bonus. They would only get $9,000, not the $12,000. So they don't get a letter from the IRS explaining. Hopefully their CPA, their tax preparer helped them understand this. But, you just think you got the $12,000 deduction and all of a sudden you didn't, but you don't really get alerted as to why. So if you want to know exactly where your numbers land against these kind of phase out thresholds, that's the kind of math that we help clients prepare for. We work closely with CPAs. We're not tax professionals. We don't do tax preparation, but we can help with tax planning, and we can also work really closely with your CPA. And so if you would like a second look at run your own numbers, we're happy to help. There's a link in the description. You can also reach out to your CPA to understand more of this deduction and the phase out and how it pertains to you. Now, let's talk about the Medicare IRMAA connection. Here's what a lot of people don't realize or don't connect, these dots don't connect, and that is the same income that cost Mark and Diane part of their deduction has another bill affected to it. And that bill comes 2 years later. Medicare uses a 2-year look back. So your premium this year is based on your tax return from 2 years ago. This is assuming you're on Medicare now. So a Roth conversion, a big RMD, a one-time spike in income doesn't just affect this year's deductions. It can also double your Medicare premium 2 years from now. And by the time it shows up, you've already forgotten about what caused it. You just get a higher Medicare bill, a higher Medicare premium. So if this happens to you, don't just pay the higher bill. You might want to try filing the form SSA 44. Tell Social Security your income hasn't changed, and they can recalculate your premium based on where you actually are now, not where you were 2 years ago. Now, this doesn't always work, but it's worth trying to see if you can get that advantage, taking advantage of that for your situation. So if this video has been helpful, if it has something that you find useful, you want to learn more about tax planning, IRMAA and Medicare and IRMAA surcharges, RMDs, Roth conversions, how you're really building all of this into your retirement plan, we'd love to help. You can schedule some time in my description below, and we'll connect over Zoom and find a time to just have a conversation to talk about your situation and what we do to help clients just like you. Be confident in your retirement. Have a wonderful day.